investing in 2026 might seem confusing, especially if you're just getting started. With so many options, new technologies, and constantly changing markets, it's easy to feel overwhelmed. But the truth is, you don't need to be an expert to begin building your wealth. With the right knowledge and a simple approach, anyone can start investing with confidence. In this video, we're exploring the beginner's guide to investing in 2026 and breaking down everything you need to know to take your first step. Today, we will talk about the beginner's guide to investing in 2026. So before we get started, make sure to hit that like button. Also subscribe to my channel, but the truth is, investing doesn't have to be complicated. Anyone can start building wealth, even with small amounts, as long as they understand the basics and follow a clear strategy. In this video, giving you actionable tips, real-world examples, and strategies to grow your money over time. Stay until the end, because even small changes in how you invest can lead to massive results in the long run. 10. Know what investing means. Investing is often misunderstood. Many beginners think investing is just buying stocks and hoping they increase in value. In reality, investing is putting your money to work to generate returns over time, whether through interest, dividends, property appreciation, or other income streams. For example, if you buy $500 worth of an index fund that tracks the S&P 500 and hold it for 20 years, your money grows not just from price increases but also from reinvested dividends. Unlike gambling, investing involves research, strategy, and patience. Understanding investing is the first step. Learn about risk versus reward, diversification, and compounding. The earlier you grasp these concepts, the better your decisions will be in 2026. 9. Set clear goals. Investing without a goal is like sailing without a map. Beginners often buy assets randomly or follow trends, which leads to losses or slow growth. Start by defining specific, measurable goals. These goals determine your investment strategy. Short-term goals may require safer, more liquid assets, while long-term goals allow for riskier investments with higher potential returns. For instance, if your goal is retirement 30 years away, investing in index funds and ETFs can provide growth with moderate risk. Clear goals keep you focused, disciplined, and less likely to make impulsive decisions. 8. Start early. Even with small money, time is the most powerful tool in investing. The earlier you start, the more your money benefits from compounding. Even small monthly contributions can grow into significant wealth over decades. Let's consider an example. Investing $100 per month at a 7% annual return from age 25 to 55 results in nearly 100,000 borzo. If you start at 35 instead, the total drops to around $50,000 borzo. This shows how critical early action is. In 2026, digital platforms make it easy to start with minimal amounts. Apps allow you to invest fractional shares, ETF, or even cryptocurrencies with just $. Starting small is better than waiting for the perfect moment. Consistency is more important than size early on. 7. Understand risk and diversify. Every investment carries risk. Beginners often make two mistakes: taking too much risk or avoiding it completely. Both can limit wealth-building potential. Diversification reduces risk by spreading investments across multiple assets. For example, instead of putting $1,000 into a single tech stock, you could invest $500 in an ETF, $300 in bonds, and $200 in a dividend-paying company. This way, if one investment loses value, others can offset the loss. In 2026, fractional shares, ETF, robo-advisors, and crypto indices make diversification accessible for beginners. Diversification protects your portfolio and allows smoother growth over time, even during market fluctuations. 6. Choose the right investment platform. Where you invest is just as important as what you invest in. High fees, hidden charges, and unreliable platforms can eat your profits and slow your growth. For instance, a beginner using a mobile investment app can start with $50, invest in diversified ETFs, and track performance daily. Choosing the right platform ensures your money goes into investments, not fees, and builds confidence as you grow. 5. Focus on long-term growth. Many beginners make the mistake of chasing short-term gains. Buying trending stocks or crypto in hopes of doubling money overnight often leads to losses. Financially successful investors focus on long-term growth. For example, investing consistently in index funds or ETFs over 10-20 years typically outperforms trying to time the market. Compounding turns small, steady contributions into significant wealth. Long-term thinking also helps manage risk and reduces emotional reactions during market dips. In 2026, with global markets more volatile due to tech and crypto, a long-term approach is safer and more effective for beginners than chasing short-term hype. 4. Learn about different assets. Investing isn't limited to stocks. Understanding asset types allows you to build a balanced portfolio. Some options in 2026 include stocks, ownership in companies' higher potential returns, but more volatility; bonds, loans to governments, or companies' lower risk and steady returns; ETFs and index funds, pooled investments that track markets or sectors great for diversification; real estate, income through rentals or appreciation; cryptocurrency, high-risk, high-reward digital assets requires research; retirement accounts, tax-advantaged accounts like IRAs or 401ks. For example, a beginner might allocate 60% to ETFs, 20% to bonds, 10% to crypto, and 10% to real estate funds. Learning how each asset works and fits your goals reduces mistakes and maximizes growth potential. 3. Avoid emotional investing. Many beginners make decisions based on fear or greed. Buying when prices are high or selling during a dip is a common mistake that leads to losses. Emotional investing often comes from reacting to news or social media hype. Financially successful investors stick to a predefined strategy. They invest regularly, avoid panic selling, and rebalance their portfolio when needed. For example, during a market downturn in 2026, someone following a consistent ETF plan continues investing instead of selling, allowing them to benefit from eventual recovery. Automated investments and robo-advisors can help beginners avoid emotional mistakes and stay disciplined. 2. Monitor and adjust your portfolio. Investing is not set it and forget it. Regular monitoring ensures your portfolio aligns with your goals and risk tolerance. Beginners should review their investments at least annually. Rebalancing may involve shifting funds from overperforming assets to underperforming ones or adjusting contributions based on income changes. For example, if your tech stock allocation grows from 40% to 60% of your portfolio due to gains, you might sell some to maintain a balanced 50/50 allocation. Monitoring allows you to capitalize on opportunities, reduce risk, and ensure your portfolio continues moving toward long-term objectives. 1. Keep learning. The most important habit for beginner investors is continuous learning. The financial world evolves quickly, and staying informed prevents mistakes and helps you seize opportunities. Read books, follow trusted financial news, take online courses, and learn from experienced investors. Understanding taxes, market trends, and new investment products allows smarter decisions. For example, knowing the difference between a traditional IRA and a Roth IRA in 2026 can save thousands in taxes over time. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.